In 2008, the system did not collapse overnight. Something that had been broken for a long time finally became visible. Banks went bankrupt. Financial flows nearly came to a complete stop. Millions of people unfortunately lost both their jobs and their homes. But financial crises do not begin when headlines appear. They begin silently, invisibly, inside incentive structures, within excessive borrowing mechanisms, inside assumptions accepted without question. 2008 was not random destruction. It was the structure confronting reality. The collapse was expected, only its timing was debated. The trigger emerged from the housing sector. For years, housing values increased uncontrollably. Access to credit was easy, danger felt distant. Subprime mortgages spread rapidly. Loans issued to borrowers with weak credit scores converted into mortgage-backed securities, then sold globally as safe investments. Risk was never removed from the system. It simply changed hands, and it was mispriced. Investors trusted the ratings. Institutions trusted mathematical assumptions. Consumers believed prices would continue rising indefinitely. Adjustable rate mortgages offered low initial payments. Speculators bought homes expecting rapid refinancing. The system encouraged expansion. It penalized caution. As long as prices kept rising uncontrollably, everyone appeared solvent. But stability built on rising prices is not true stability. It is only temporary momentum. By 2006, the housing market peaked. Prices stopped rising, the trend stalled, interest rates were adjusted upward, refinancing became more difficult, defaults increased. When borrowers could no longer refinance, the securities backed by those loans began to lose value. The illusion cracked, trust eroded. What appeared diversified was in fact tightly interconnected. In 2007, two hedge funds owned by Bear Stearns collapsed. Markets reacted cautiously. But the real problem was in the funding structure. Major institutions were using short-term funding to carry long-term risk. When confidence weakened, liquidity dried up, leverage reversed, the debt structure began to collapse. Forced selling pushed prices lower. Falling prices triggered more selling. The system created a chain reaction. September 2008, Lehman Brothers declared bankruptcy. Credit markets froze, trust disappeared, banks stopped lending to one another, companies could not access capital. What began in housing spread into the real economy. Approximately 9 million jobs were lost in the US. Global markets fell sharply. The shock was not isolated, it was systemic. Governments intervened directly. TARP injected hundreds of billions of dollars. Central banks cut interest rates to historic lows. Liquidity programs expanded rapidly. The financial system reached temporary balance. Over time, bailout funds were repaid. Markets entered a recovery trend. But stability does not erase structure. The architecture that enabled the bubble was not accidental. The crisis exposed deeper weaknesses, uncontrolled leverage, fragility in shadow banking, excessive reliance on short-term funding, incentives that rewarded risk without accountability. The financial sector had outpaced regulation. When housing prices fell 30% and equities dropped nearly 50%, it revealed how interconnected risk had become. The system was not malicious, but it was misaligned. 2008 was not merely a housing bubble, it was a lesson in fragility. Stability can be manufactured for years. Cheap money policy, easy credit access, rising asset prices. But when growth is built in debt and confidence replaces capital, correction becomes inevitable. Collapses do not emerge suddenly. They become visible when resilience thresholds are exceeded. The real question is not whether they will happen. It is when the structure will meet its limit again.